Hey, hope you're all doing well out there. This is your June market review. So the reason that I put these videos together each month is to get you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to give you the straightforward information with none of that media spin and go over what's going on in the market and the economy and ultimately then how that affects your money. Stocks for the month of June were up across the board. The S&P 500 was up about 3%, so that's the largest 500 companies in the stock market. The NASDAQ 100 was up about 6%. The NASDAQ 100 are the largest 100 companies in the NASDAQ exchange. And then small cap stocks were roughly about flat for the months. So stocks are still right near all-time highs, even through some fluctuation here in the first week of July, which is reflective within your account. So I'm going to go over a few different charts here. I'm going to try to speed through these just not to make the overall video too long today, but I have 4 charts to go over with you. So the first chart is the 10-year Treasury yield rate. So in this chart shows going back through 2020, right before the COVID drop-off, basically the interest rate that you would make if you were to invest in a 10-year Treasury note. So the reason that I'm going over this chart is the 10-year Treasury yield is a very important yield to track when it comes to bonds. So bond prices are, and really a lot of interest rate prices like mortgage rates, car loans, CDs, a lot of things are based off of this 10-year yield. So if 10-year yields are dropping, a lot of other rates like mortgage rates, car loan rates, other rates like that may be dropping or increasing, vice versa if these yields are going up. So generally speaking, the 10-year yield can be a great determinant or predictor of what is going to happen in the stock market. So that's one of the reasons that I'm bringing this up, because the bond markets, which treasuries are invested through, are a lot of times more predictive of what's going to happen in the broader economy than the stock market is. So not always the case, but you can see going back through the beginning of 2020, bond yields really started dropping off in the first couple months of the year as COVID started becoming more and more of a potential, issue. And this was, if you look back at the very beginning of 2020, there was in the beginning of 2020, this was a China thing. That was like something you watched on the news. This wasn't, COVID was not a US or an international pandemic by any means, but yields were starting to really drop off at the very beginning of, or the end of January and into February, and they, really crescendoed in mid-March there, where they really dramatically dropped off. If we were to look at the stock market didn't really start dropping off until the very end of February. February 19th was the peak of the stock market in the very beginning of 2020 before rebounding back. If we fast forward though through today, if we're looking at the charts, bond yields had really spiked up in the beginning part of the year as kind of a predictor of, well, the economy is going to be doing better. Yields were going higher because of that. Recently, though, they've really started trending off, and especially here in the last few weeks, have dropped pretty dramatically from 1.5% to about 1.3%, which is a big move for the 10-year Treasury to move. And that could be a predictor of maybe some short-term volatility, which is the only reason that I'm actually bringing this up, is that I would expect to see some sort of short-term volatility in the stock market over the next few months. And the bond market and the 10-year Treasury specifically is a good predictor of it. So not to, stick too long on that one chart, but that was the one point that I wanted to kind of make with that. And I thought it was an interesting chart to bring up and show all of you, because it is very important to look at that as far as yields go. And, these aren't just for treasuries, but they're for mortgage rates and other things. So on to the next chart. Consumer Confidence Index is the next chart that I have up here. So this shows, going all the way back through 2016, all the way through today, what the consumer confidence is actually showing. So the reason that I thought that this was an interesting chart to bring up to you guys within this market review was that we're not quite back to where we were before the COVID drop, but we're getting closer. And this is a really good sign of positive, consumers out there that are feeling really good about buying stuff. And when people are buying more things, especially right now with all the money that people have saved up throughout the pandemic, the broader mass amount of people have a lot of money to spend. So this is a great sign to look at from an economic standpoint, which is going to end up spilling over into the stock market. One of the reasons that I feel that over the next year the stock market is heading higher. Obviously, other things could happen over the course of the next year, but based on where we are right now today, it's a really good feeling to see numbers like that come out and showing kind of the signs of, well, where is the economy heading, and what's more important for you guys is where is your investments in the stock market heading. So which all of you have some tie-in to or money indirectly invested within the stock market. So that's why I go over that. On to the third chart here, finding jobs. I also thought that this was a good chart to look at because it goes into kind of where we are in the jobs market right now, which is an interesting dynamic. So you see the top line there that represents jobs that are plentiful. This was showing kind of the drop off here in COVID, and then the spike that we've had because there are plenty of jobs out there that people are trying to hire. The other line is showing jobs are hard to get, which right now it's not hard to get a job. It's at a 5-year low as far as how hard it is to get a job because there are so many jobs available. So I thought it was a very interesting chart because that's such a wide divergence between the two, and even more extreme than before COVID, that at some point, those people, what'll end up happening at some point, once they stop unemployment and all of the additional stuff with that, I think that there's going to be a large amount of companies that are going to have to pay more to get people to work, which, yes, that's going to cause some inflation and prices going up, but that's already, people have already had wage inflation, which isn't a bad thing because that just means that more people are making more money. And generally speaking, the lower income people that are making more money aren't traditional savers, which means they're going to spend more money, and that money is then going to just be regenerated back into the economy. So, that's one of the things that I think is a really good sign to see that there are so many jobs that are actually available. So, that was an interesting chart. I thought I don't want to spend too much time on that one either because I want to keep this as a shorter video and kind of get things moving through. Last chart I have though, completely outside of my sphere as far as investing goes in the stock market. This is showing the home price index year-over-year change. So I'm not a realtor, but for most of you that are my clients, your house is one of your biggest assets. And if you don't have a house and you're looking at getting a house, I also thought this was important to see. So that way you could see kind of some of those year-over-year changes. But this is a national home price index that shows the year-over-year change from the year prior, and we just hit a 10-year peak with about 15% year-over-year gains from last year at this point, or actually it was last year in the month of May, and the month of June through this year as month of June, there was a 15% increase in the price of houses. So that's not obviously specific to one market of central Pennsylvania or Florida or Texas or wherever. It's just everything cumulatively as the United States. That's what housing prices have gone up, which is a pretty dramatic increase. You typically don't see a double-digit type of return. The only time in recent years there's been that was in 2013, 2014 when there was a 10+% climb over the year prior, followed by then a dip. But that was following the rebound that was from the housing crisis. So there were still a lot of lagging changes year over year in markets dropping off from 2008, 9, 10, all the way through 2012. And then you fast forward to the rebound that then happened at that point, kind of seeing, following a similar trend to where we are now, just at a little bit of a higher point. So would I expect it to stay at that level? Probably not, just based on, history generally repeats itself when it comes to markets, and, the housing market is no different than any other market out there, just like the bond market or the stock market or the gold market. So at some point it'll probably come off its extreme highs of 15%, but nobody knows exactly when. But one point to take away from this is one of the things that people are seeing, or that economists are seeing, is what's called the wealth effect. So when you guys were looking at your accounts in your statement from April in 2020, and the market had just dropped 35%, I'm sure like none of you out there, and I know a handful of you because I got those phone calls, were definitely not excited to see their accounts drop as dramatically as it did during the beginning of COVID. And that's like the reverse aspect of the wealth effect, where all of a sudden your money is worth less. People don't feel as good about spending money or their overall personal finances when they see any investment go down, whether that be their retirement account in their IRA, 401k, or general investment account that I may be helping you out with, or seeing the price in their house go down. So it works reversely. When things are going up, everybody feels better. I get more calls and more conversations with people that want to become more aggressive now, that maybe before weren't really very aggressive, and they like to step further and further out onto that risk and try to make more money. Part of my job is then kind of like honing that in, because there's the other side of that, because when you take more risks, there's more potential for loss. But when you're looking at something like the value of your house going up, and you see houses in your neighborhood going higher and higher, that makes you feel better about, ultimately, even whether it's a conscious or a subconscious thing, you feel better about your overall financial position and that your house is now worth more. What it does is it leads to real decisions that are made, like maybe improving your house. And that could be buying stuff to renovate a kitchen or a bathroom, or do other outside landscaping projects, things like that otherwise you may not do if you didn't feel that your house was appreciating at the value that it is. So I thought that was a really good chart, just because a lot of you out there that are my clients are homeowners, and I thought that this was interesting to see, because the wealth effect is definitely an important part of not just housing and all of that, but the wealth effect is a big player within the stock market, because the more money that people see within their account, the better that they feel. And they may not necessarily be taking money out of their investment account or their retirement account, when it's grown and moved up as it has over the last year, but they feel better, so they might go out and spend more money from their general income. So when they're spending more money, that's helping out the economy, whether that be the local economy or for people that are doing home improvement projects. Lowe's and Home Depot, I've heard, are top on the list of places that people have been spending money. So I thought that these were all interesting charts to go over. A quick housekeeping item here to follow up on the new client portal. You all should have gotten, as clients, you should have gotten an email from me either the very end of May or the very beginning of June with the two, or actually should have been two emails that were sent out. One was for the access to the mobile client portal. The other was for the computer version of the client portal. And that just gets you, there are just links in there that get you to the site, or get you to download the app. And then there's the password and everything that would get you set up within there and prompt you to reset that password. So everyone at this point should have received those emails. If you haven't received those emails, reach out to me. I'd love to get you set up with that client portal. It's a real big improvement on the previous client portal. It shows all of the different reports that I typically would go over during a client review. And it's something that you can view on your phone or on your desktop computer whenever you want to. It shows all of the numbers for your account, and it can be changed based on time frames. A lot of graphs to it, very visually appealing. There's also a vault in there where every single month your monthly statements from TD Ameritrade will be sent, as well as every quarter. I just uploaded a quarterly investment report that goes over, it's the exact same report that I would go over with you in person. Shows all the transactions that were placed within the accounts for that previous quarter. So if you have questions, feel free to just reach out to me. I'm happy to kind of set that up for you, or get you logged into there and get you all set up with that. The next round of in-person reviews I'm going to be doing is going to be after the summer. I just completed a round of reviews here in this past June. If you'd like to schedule a meeting or just have a conversation, I'm always flexible via Zoom. If you want to do a screen share, that's the best way, obviously, to do it. If you just want to have a conversation, obviously, more than available. Call, text, email, more than available, obviously, to answer any questions. If you have any questions, don't hesitate to call, text, or email. If you have friends or family members or coworkers or someone that you feel would be interested in having a conversation with me about their investments, don't hesitate to give them my info, or if they'd rather me reach out to them, give me their contact info, and be more than happy to touch base with them. But I appreciate your guys' time, and look forward to connecting with you guys next time. Thanks for checking me out.